Welcome back to the show, Yuvs. We're diving deeper into Python for algorithmic trading, specifically Chapter 6 on event-based backtesting. This seems like a crucial aspect. Can you tell us a bit more about the advantages of this approach compared to vectorized backtesting?
Absolutely, Matthew. Vectorized backtesting, using libraries like NumPy and pandas, is super convenient for simple strategies. It's really fast because of the optimization of those libraries. But, as you know, real-world trading is complex. There are limitations.
Right, I remember us discussing those limitations in the previous segment. Can you briefly summarize them?
Sure. One key issue is the look-ahead bias. Vectorized methods use the entire dataset, which in reality isn't how trading unfolds. New data arrives incrementally. Also, it struggles to model certain realities of trading like fixed transaction costs. You can't properly account for those kinds of costs or, say, the non-divisibility of financial instruments, like a single share of stock. Finally, the approach also doesn't handle algorithms that are path-dependent. That is, those strategies where your profits and losses accumulate over time, and those accumulation results are dependent on events that happened earlier in the trading history.
So, event-based backtesting addresses these shortcomings?
Precisely. It models trading more realistically, taking into account incremental data arrival. Imagine you're backtesting a strategy for Apple stock. Instead of using all the data at once, an event-based approach would process each new closing price as an event. Similarly, any other new data, a change in interest rates, hitting a stop-loss level, would be an event.
This incremental approach seems vital. And what exactly is the benefit of this?
Well, with an incremental approach, you can model things like transaction costs and the non-divisibility of shares, aspects that are tough with vectorization. You also gain the flexibility to incorporate conditional or recursive calculations. For example, tracking the maximum or minimum price seen so far, which would be a path-dependent statistic, is a dawdle. So it offers a more realistic simulation of trading behavior.
So, you're saying it can handle path dependency, which is a big deal for algorithmic trading.
Yes, definitely. That recursive structure is precisely what event-based backtesting can capture, because it's focused on the arrival of new data and how it changes the state of your trading system. It's not just about the final result, but about how those results are reached.
It sounds like event-based backtesting is more flexible and detailed. You mentioned reusability. Why is that important?
Because you need to be able to test different trading strategies. The benefit is that, with event-based backtesting, you can build a foundation with a set of classes that can easily be reused when implementing different strategies. It allows for a more unified and organized backtesting framework. It's much easier to reuse and adjust.
So, that reusability and flexibility are two critical advantages. And what about potential uses in live trading from this event-based backtesting?
Yes, Matthew. Sometimes, parts of the event-based backtesting system can be used to automatically implement the trading strategy itself, helping to automate the actual trading process.
That's fascinating. So, event-based backtesting is more nuanced, more realistic, more adaptable, and could even help in automation. Thanks, Yuvs, for that great explanation.
You're welcome, Matthew.
Welcome back to the podcast, Yuvs. We're diving deeper into this Python for algorithmic trading book, and we're now looking at this crucial backtest-based class. So, this is the foundational class, right? The building blocks for all the different strategy backtests?
Absolutely, Monsieur. This backtest-based class is really the heart of the matter. It handles the common tasks, like data retrieval, order placement, and closing positions, so that when we build specific strategies later, we don't have to rewrite all this boilerplate code. It's a huge time saver.
Got it. And the data retrieval, that's a key piece. How does it get the end-of-day data?
It assumes you have a CSV file. Crucially, it's getting data from a specific URL, http://hilpish.com/pyoilgo_icon_eod_data CSV single quote. So it's a pre-built example, but you could easily adapt it to use your own data source. The code reads the CSV, selects the desired stock symbol, like AAPLO, filters it to the specified start and end dates, and then calculates log returns. That's really important for understanding the percentage changes over time. The log returns are saved into the return column.
Interesting. So, This whole CSV data thing makes backtesting easier?
Exactly. Imagine if we had to manually load data from different sources for each strategy. That'd be incredibly time-consuming and prone to errors. This class handles all that, giving us a standardized, structured way to input the EOD data.
Okay. And what about the helper functions, like plotting the data and getting date and price information?
Sure, they're very helpful. Plot_data just gives us a simple chart of the closing prices. It's super handy for quick visualization. And get_date_price lets us easily pull out the date and corresponding price for any bar data point in our dataset. This is essential for the other methods that need to calculate values for specific dates.
Now let's talk about the order placement methods. Place_by_order and place_cell_order. Can you explain how they work, focusing on what's happening with the transaction costs?
Sure thing. They're straightforward. You pass in the bar data point, and potentially the number of units or the amount to spend. They calculate the units, if necessary, and reduce or increase the balance accordingly. Importantly, they account for both fixed and proportional transaction costs. So the amount you pay isn't just the price multiplied by the units, it's adjusted for these costs. This is something we often overlook, but it's essential for realistic backtesting.
The code actually subtracts the cost from the cash balance, right?
Exactly. The crucial line is where they adjust the balance using self mount -equals units *price *1 plus self PTC plus self FTC. That takes into account both fixed transaction cost, self.ftc, and proportional transaction costs, self.ptc. It's important to note that no error checking is done, so you should ensure that there's enough cash.
And how does the closing out of positions work?
The close_out method is very clean. At the end of the backtesting period, it accounts for the current holdings and updates the self amount with the total value of the position. It does not apply transaction costs when closing. Critically, it calculates and displays the final balance, net performance, and the total number of trades.
So, the whole point is to create a reusable class for different strategies, using standard practices for data handling, order execution, and evaluation?
Absolutely. The backtest base class really gives us a solid foundation. It encapsulates all the common backtesting logic, making it extremely easy to develop and test different algorithmic trading strategies. That's a key strength of object-oriented programming in this context.
Welcome back to the show, Yves. We're diving deeper into this fascinating long-only backtesting class concept from the book Python for Algorithmic Trading. We were just talking about how, with these long-only strategies, you're limited to buying or holding cash. Can you unpack the implications of that restriction?
Absolutely, Matthew. That restriction on short selling has a significant impact on the types of strategies you can employ. Instead of trying to profit from price declines, you're focusing on identifying opportunities where prices are likely to increase. It fundamentally changes the investment landscape. You're looking at different metrics and signals for when to buy and sell to maximize returns within those restrictions. It essentially boils down to a fundamentally different set of assumptions for modeling the market.
So, the run_mean_reversion_strategy method, as you mentioned, is quite crucial here. Could you walk us through the logic step by step?
Sure. The method first prints out some important parameters, the simple moving average, SMA period, and the threshold for the deviation from the SMA. You'll notice it also includes transaction cost information. That's super important in a real-world backtest. It gets the fixed and proportional transaction costs. Then it initializes a few variables, self-position, which tracks whether the portfolio is long or not, the number of trades, the current cash amount, and calculates the SMA values for the chosen period.
Right, the SMA calculation is crucial. What's the significance of this rolling mean in this strategy?
The rolling mean acts as a signal. It's a smooth moving average of the price over a specified number of periods. If the current price falls below the SMA minus the threshold, the algorithm places a buy order. The logic assumes the price will revert to the SMA over time. The if conditions carefully examine the current price against the SMA and the threshold to determine whether it is worth placing a buy or sell order. It's a fairly basic, but well-established form of mean reversion.
Okay, so it's essentially checking if the price has drifted significantly below the average. And what happens when the price goes back up?
Exactly. If the price rises above the SMA, Then a sell order is placed to cash out the position. It gets back to a neutral market position. The self.close_out method ensures all open positions are closed at the end of the period. This is important because the method doesn't assume the market will stay stable forever.
This logic seems clear, but the results highlight something really interesting. It looks like mean reversion, while a seemingly promising strategy, could be significantly impacted by transaction costs. Why do the transaction costs have such a drastic effect?
Transaction costs, both fixed and proportional, eat into the profits directly. As you see in the backtest results, the more frequent the trading, the bigger the negative impact. Mean reversion strategies, in their nature, can trigger more buy and sell orders than simpler SMA or momentum strategies. That extra trading volume directly increases the transaction costs. This emphasizes the importance of considering transaction costs in your backtesting.
So, the strategy that initially looks most profitable might be less so with real-world transaction costs. That's a critical point.
Exactly. The data shows that a strategy with fewer trades, even if it doesn't have the highest potential profit, might perform better in the presence of transaction costs. This is a key lesson in algorithmic trading. Always account for real-world market realities and costs.
Great insights, Yves. This is really helpful in understanding the practical implications of this code and the backtesting results. Thank you. Welcome back to the show, Yves. We're diving deeper into this Python for algorithmic trading book today. We were just talking about the backtest long-short class and its methods like go_long and go_short. Can you walk us through how these are implemented?
Sure, Matthew. The go_long method, as you pointed out, is designed to execute a long market order. Crucially, it first checks if there's an existing short position. If there is, it closes that short position first. Then, it looks at whether the user has specified the number of units to buy, or the amount in currency. It handles both options gracefully, offering flexibility. If units are provided, a buy order is placed for those units. If amount is specified, it gets a little more interesting.
Interesting. Tell us more about the amount parameter.
Yeah, if the user provides an amount, there are two scenarios. If the amount is the string all, it means the algorithm should utilize all the available cash. This is a powerful feature, but crucial that enough cash is available to complete the order. The other case is when the amount is a numerical value. The code simply uses that amount to place the buy order. It's important to note that this implementation doesn't check for liquidity.
Tats a deliberate design classe.
It simplifies the class, but importantly, the user must ensure they have enough funds, and you need to be very aware of that in a real-world implementation.
So, it's a bit of a trade-off between simplicity and robustness.
Absolutely. The go_short method mirrors go_long, simply reversing the actions, closing any existing long positions before executing a sell order based on the provided units or amount. The key takeaway here is the prioritizing of closing existing opposite positions before initiating new ones.
Okay, now let's talk about the run_mean_reversion_strategy method in the backtest long-short class. You mentioned that this strategy is more complex because of the intermediate market neutral positions. What makes it different from the other strategies?
Right, this strategy dynamically adjusts based on the difference between the current price and a simple moving average, SMA. If the price is significantly below the SMA, it goes long. If the price is significantly above the SMA, it goes short. It's essential to have a threshold which is a tolerance level above or below the SMA. Importantly, it also handles closing positions when the price reverts back to the SMA. This creates the nuanced market neutral positions. The for loop iterates through the data, checking the price against the SMA, and executes trades accordingly.
So, it's reacting to price movement relative to the SMA. What about the performance results you mentioned, which showed some concerning outcomes with losses even after transaction costs?
Precisely. The results highlight that a strategy's potential for success isn't guaranteed simply by adding shorting capabilities. The tests show that without considering transaction costs, the results are not necessarily better, even worse in some cases. A crucial point is the potential to quickly lose all initial capital if not carefully managed. This is particularly concerning when dealing with leveraged instruments like CFDs. You could quickly accumulate debt if the strategy isn't well tuned to account for the potential volatility.
Thanks for clarifying the complexities involved in designing and backtesting robust algorithmic trading strategies. This is excellent context for understanding the potential pitfalls when implementing strategies, including the critical need to incorporate appropriate risk management techniques. We'll delve into specific risk management strategies in upcoming episodes. Welcome back to the show, Yves. We were just discussing the benefits of vectorized backtesting, and now we're diving into event-based backtesting. Could you elaborate a bit on why event-based backtesting is sometimes a better choice, especially for strategies with fixed transaction costs and complex logic?
Absolutely, Matthew. Event-based backtesting, well, it really shines when you're dealing with those nuanced strategies. Vectorized backtesting is great for simpler models, but it essentially treats everything as happening simultaneously. It can be a bit of a simplification. Event-based backtesting, on the other hand, is really granular. It processes each event, each new data point or market signal, individually.
So, it's like a step-by-step analysis, rather than a bulk operation?
Exactly. This individual processing is crucial when you introduce transaction costs. Imagine a trading strategy that triggers multiple trades in a short time frame. With vectorized backtesting, you might lose precision because, all the trades are handled simultaneously. Event-based backtesting allows you to track the exact costs of each trade, which really impacts your strategy's profitability. It also allows for more complex logic. You can build in stop-loss orders, conditional trades, or even model different types of market orders in a granular way.
Okay, so you're saying it's more flexible, more adaptable?
Absolutely. And the key benefit is that complexity doesn't become a roadblock. You're not restricted to simple, easily vectorized operations. The base class is crucial here, right? This foundation handles the fundamental backtesting logic. Then, specialized classes like the long-only and long-short strategies build on top of that base, adding the specifics of their respective models.
So, the backtesting base class is like a toolbox of general functions for backtesting, and then the long-only backtesting class and long-short backtesting class are essentially applications of that toolbox to specific strategies, right?
Exactly. The base class provides the framework for things like handling data, calculating returns, and managing the overall backtesting process. The specialized classes build on this, including their strategy specifics. It's a very modular approach. And since they are all built upon the same foundation, enhancing or modifying these specialized classes, well, that becomes easier and much faster.
So, by having these modular classes, you can easily test different variations of long-only or long-short trading strategies and compare their performance.
Exactly. The book goes into detail about all three strategies from Chapter 4, so you can really see how to implement them within these classes. It's a practical approach for a programmer, allowing them to refine their own strategies quickly.
This sounds really powerful for developing and optimizing trading strategies. So, you're essentially building a framework for quickly testing, refining, and comparing different approaches to market timing and trade execution.
Exactly, and remember, event-based backtesting allows you to examine strategies in a very nuanced manner, making it a powerful tool for analyzing market behavior, developing and honing your skills, and for generating a more thorough understanding of your strategies.